Pesa, pesa, pesa. That is what we are seeing in stock market today. Almost every week, stocks are at all-time high. Investors are happy, they are booking profit. But do you know the profits which you book from these stocks are taxable? Really? Yes, they are taxable. In this video, I'll give you tips on how you can save these taxes from mutual funds, stocks, equity, shares, etc. Hi guys, this is Nishant and welcome to the School of Personal Finance. In today's video, we will be looking at tax harvesting. The topic is huge and hence I'll be breaking it into two videos. In part 1, we'll look at the concepts with examples, and in the next video, in part 2, I'll look at real life scenarios where I'll show you some real examples of how to do tax harvesting. We will also look at the things to remember and a special section or the bonus section which will give you information about smart tips to save your tax via tax harvesting. So let us focus on this video and let's go to the concepts. I hope you remember Mishra ji and Sharma ji from our previous video on compound interest. If you have not seen that, I recommend you to do watch it because it gives you some cool tips, tricks to increase your wealth. The description and the link is given on the I button at top right corner of your screen. So we have Mishra ji and Sharma ji who have purchased Tata Motors share, both purchased in 2019, 1st January, and they have different selling strategies. So while Mishra ji had purchased in 2019, he held on for 2 years and then sold the share on 1st January 2021. Sharma ji on the other hand, he purchased on 1st January 2019 and sold it on 1st January 2020. But he again bought it on 1st January 2020 and sold the shares on 1st January 2021. So effectively, the profits made by both are 2.5 lakh. But the big question is, who saves more tax? Will Sharmaji's strategy of selling and buying help him save taxes? Or is it Mishraji who is saving more taxes? Let's find out. So let us look at concept 1, LTCG versus STCG. LTCG stands for long-term capital gain and STCG stands for short-term capital gain. As per the Indian tax laws, any profit you make after selling a share which you have held for more than 1 year is called as long-term capital gain, and you have to pay a tax of 10% over 1 lakh profit on it. The shares which you have sold within 1 year, those are short-term, and the profits which you make out of them are known as short-term capital gains, and you have to pay a flat tax of 15% on them. So now let's see what are the tax liabilities of Mishra ji and Sharma ji. So Mishra ji had held the share for 2 years from 2019 to 2021 and hence he falls under LTCG bucket. He purchased the share at 1 lakh rupees and sold it at 3.5 lakh rupees. So his profit is 2.5 lakhs and his tax will be 2.5 minus 1 lakh, which is equal to 1.5 lakhs, and 10% of that, which is equal to 15,000 rupees. So Mishra ji will be paying 15,000 rupees on the profit which he made by selling Tata Motors share after 2 years. In case of Sharma ji, he held the share for 1 year here. His cost price was 1 lakh and the selling price was 2 lakh. So his profit was 1 lakh. The tax which he will be paying is 1 lakh minus 1 lakh, which is equal to 0, and 10% of 0, which is equal to 0. So there is no tax which he'll have to pay here. In 2020, again, he falls under LTCG because he has a 1 year holding period here. And the profit is 3.5 lakh minus 2 lakh, which is 1.5 lakhs. So his tax will be 5,000. So as you see, just by doing a simple trick of selling and buying the share, Mishra ji has been able to save 10,000 rupees on his taxes. He has to pay only 5,000 rupees as his tax, while Mishra ji had to pay 15,000 rupees in his tax amount. This is the case of LTCG, long term. What would have happened if they had held on for a period less than 1 year? It's very simple. The calculations would have been directly at 15%. So if this particular duration would have been less than 1 year, the 1.5 lakhs here profit, that would have been multiplied by 15% to get the tax liabilities. So 1.5 lakhs into 15%, which is equal to 22.5k. This is the tax which the person would have paid. Now this particular strategy of buying and selling the shares to save taxes is known as tax harvesting. Moving on, let's try to understand the LTCG and STCG concept in detail via some more examples. So here I am showing some particular share transactions, some buy and sell. Let's see how each of them can be classified. Tata Motors we have already classified. Yes Bank, he has held on to the share for 2 years, so it is a long term. He purchased the share at 1 lakh rupees. However, he sold it at 15,000 rupees. So he is making a loss of 75,000 rupees. His long-term capital gain is minus 75,000, which is called as long-term capital loss. And since it is a loss, he will not have to pay any tax on it. So LTCG is equal to minus 75,000 and tax equal to 0. Coming to Jet Airways, this particular person has held on to the share for only 10 months. So this will be a short-term share for him and it should be taxed at 15%. Again, a loss of 2 lakhs. So since it's a loss, he will not be paying any tax on it. HDFC, long term because he has held on for 1 year. He has made a profit of 3 lakhs. So his tax will be 20,000. IRCTC, held on for 8 months, so short term. The short term tax which he has to pay is 15,000. As simple as that. So the lesson which we can make out of this particular slide is that you can have both profit and losses in long term and short term. If you make profits, those are known as long term capital gains or short term capital gains. And if you make losses, they are termed as long term capital losses or short term capital losses. And we use this strategy in tax harvesting for our advantage. Let's see how. We move on to the concept 2, which is related to capital gain tax adjustment. As per the Indian tax laws, if you are having a share which you sold in short term and made a loss, you can adjust it or offset it against the profits which you make from selling both short term shares and the long term shares. However, in long term, the losses can be adjusted only against the long-term gain. Let us look at it against the examples. So from the previous slide, we have seen that there are few long-term gains, few short-term gains, and few short-term losses and long-term losses. So now let us use this particular table to understand our overall capital gains or losses. In short term, this particular person has made a loss of 2 lakh here. However, he has also made a profit of 1 lakh. So as per our definition of short term, losses can be adjusted against short term capital gain and long term capital gain. So first let's adjust our short term. So minus 2 lakhs plus 1 lakh, which is equal to minus 1 lakh. He is still having short term losses and hence his tax liabilities are 0. Now let us look at the long term. So 1.5 lakhs minus 75,000, which is equal to plus 75,000 profit, plus 3 lakh, which is equal to 3.75 lakhs profit. So he has made a total profit in long term for 3.75 lakhs and hence his tax liability will be 27.5%. However, we still have this 1 lakh rupees as short-term loss, and as per the rule here, this short-term loss can also be adjusted against long-term gain. So what happens is we adjust it here. So this 3.75 lakhs of this particular value comes here and minus 1 lakh comes here, and your total tax or your total capital gain turns to 2.75 lakhs, on which by using the formula you will have to pay only 17.5k as taxes. So again you are saving 10,000 rupees in your taxes. So this is how the capital gain adjustments work, and tax harvesting can utilize these adjustments. And that brings us to our lesson of this particular slide. Adjust losses to reduce your taxes. And this strategy of adjusting the losses against the profits is known as tax loss harvesting, carry forward of losses. So there can be situations wherein even after doing the tax loss harvesting, you are still in red. That means you are still in losses. So Indian government or Indian tax laws again gives some particular allowance for that. You can carry forward your losses for a maximum period of 8 years, 8 financial years, provided you declare them in your income tax returns. So let us look with some examples. What happens in our case if the Jet Airways, which we had earlier considered as a short term, is now changed to a long term? So if this particular share was purchased and sold in 2019 instead of 2020, then it would not have been classified for financial year 2020-2021. So during filing of ITR returns, you would not have calculated the short-term capital gain or short-term capital loss of 2 lakhs here. So in that particular case, overall capital gain would have been 1.5 minus 75 plus 3 lakhs, which is 3.75 lakhs, and you would have paid a tax of 27.5k. And on the short-term gain, which you could not adjust against short-term loss, you would have paid a tax of 15k. Right? Simple. Now, as I said, we can carry forward the losses for 8 years. So, what we can do is this 2 lakhs, we can carry it forward in 2020 financial year as well. We again get back to the same value. So, LTCG of 3.75 lakhs, which you got from here, STCG comes to 1 lakh, which we have here, minus 2 lakh, which is the carry forward from previous year. So your total STCG is minus 1 lakh, and since the short-term losses can be adjusted against long-term gains, you have 3.75 minus 1, which is equal to 2.75 lakhs as your total capital gain in financial year 2021. And then you will have to pay the tax of 17.5 thousand rupees. So what we learned from this particular slide is that you can carry forward your losses and use it against any long-term capital gain or short-term capital gain which you might have in future for a period of 8 years. So guys, that brings us to the end of part 1. In our next video, which is part 2, we will look at real life examples of how to do tax harvesting, few important things related to tax harvesting which you must know, and I will also give you few smart tips related to tax harvesting which will help you save and maximize your earnings. So make sure that you watch that particular video. Until then, do remember to like, subscribe and share my channel, and see you soon on part 2 of tax harvesting. Bye. Tada.